Welcome.
You ready?
Red bar is moving, Matt. I'll let you know it's halfway through. I'll have to show you how this works. Redirecting to YouTube. And I believe we are now.
We're streaming, bro.
And actually, it was already doing it. So we are already live here now for a few seconds, and we are ready to go. Matt, welcome out to our halftime report. Go ahead and play our intro, and then let's light this thing up.
Welcome to the halftime report, presented by Tackle Trading.
Tackle Trading halftime report. It's a big day in the market. Coach T, Tim Justice here with my brother, my cohort, Coach Matt. Matt, Federal Reserve today, Apple earnings. No time to mince words. We got to dive right into the analysis. First of all, how are you doing today?
Doing absolutely fantastic. Maybe not as good as Apple's earnings, but doing pretty good nonetheless.
Apple's the headline. Okay, by the way, Federal Reserve, not the headline, in my opinion. It is going to be the headline at some point, and it's always key that we talk about it. Bank of England has a policy decision overnight as well, going to be important. But when the biggest company in the world gaps out on strength and gains $50 billion in market cap in one day, Matt, that's the headline. But we're going to go through the analysis of the market one step at a time, like we always do. S&P 500 sitting at 2809, right on support. Do you see this as continuing to be bullish, continuation from the overall trend, caution ahead of the Fed? What's your overall opinion here?
The economy is doing rock solid right now. Earnings earnings for the most part have been really, really good this year. Economic reports have been really good. Manufacturing data today had a little bit of a drop down, but overall the economy is doing really well. The unemployment market's doing, or the labor market's doing very well right now. The Apple's earnings should be carrying the market, no doubt about that. It's not, but it should be. And the only reason it's not is the market's a little nervous about tariffs. It's a story we've heard many, many times when the market comes down a little bit is tariffs. Trump putting it out there that we might be increasing to 20% on $200 billion worth of imports coming out of China. I think that's just kind of a shot across the bow, to be perfectly honest with you, to get China to the trade negotiation table. But that's still a little scary. China came right back and said, if they do that, we'll retaliate. This is how trade wars start. I'm a little nervous about it, and so is the market.
You know, the old Ohio State thing was 3 yards in a cloud of dust. I think Trump is tweeting like a storm, and then, hey, let's sit down at the table. He's got a playbook strategy, Matt, and you got to commend him for that. He puffs up his chest, he gets real loud, and then eventually he's going to come back and negotiate these deals. I don't see them continuing to just ramp up this, trade war stuff forever. Well, eventually they're going to do business, don't you think?
I don't know. I mean, China and the U.S. always does business. It's a matter of how much business and how much growth are we going to have. China's stock market's not doing good right now. China's economy is not doing good right now. It's slowed. It showed slowing growth. The slowest month it's had in the last 9 months this previous month. The international markets are very skittish right now from a trade perspective. We went from zero tariffs on Chinese imports to a projection of 10% on 25 billion to a projection of 20% on 200 billion. China's retaliated, Canada's retaliated, Europe's retaliated from a trade perspective. And we're only about 3 months into this trade discussion, Tim. So, as you see it right now, it's done nothing but escalate outside of a few discussions with the European Union last week. So, I'm not seeing a deceleration from this trade discussion conversation. So, yeah, it's a little nerve-wracking from a trade discussion perspective, Tim. Trade tariffs and trade wars create massive economic upheaval from a historical perspective. And so, yeah, I mean, there's almost every reason from an economic perspective and a market perspective for the market to continue to be bullish right now. Okay. Earnings have been good. Apple's earnings were a rock star earnings report, but there is I want to say there is some grave concern over that trade discussion. And that's really the only thing stopping this market from flying.
Well, also caution ahead of this announcement, I'm sure. A little bit of both and a lot going on. And the market should be up.
Gosh, just to be honest with you, Tim, the Fed today is, and I've said this for last week, the Fed today is nothing. This report is nothing. The the Q&A session afterwards, maybe. I'm looking forward to the minutes coming out of this meeting. I think the Doves are hoping that, Jerome Powell comes off his aggressive hawkish stance of continually raising rates. So I think the minutes, even 3 weeks from now, the minutes are more important than what this Fed meeting is going to show today.
Now, by the way, Matt, I want you to real quick, drop your screen, reshare it. I think it's coming in that blue green thing again. We'll get it set up one step at a time. And while we do that, first of all, I agree with you, but the Federal Reserve is something you always got to pay attention to. The day I sleep on a Fed announcement, I don't think so, right? I mean, you can't avoid it. You still have to respect the fact that the most important central bank in the world is going to be making a policy statement. Now, Matt, we know what that policy statement is going to be. They're not raising rates, and it really just comes down to the language they use and how the market interprets it and reacts. That announcement is in about, T minus 80 minutes from here at 2 o'clock Eastern time. We'll come back to that here in a minute. From a chart perspective on the ES, that's an inside candle. So is it changed your opinion of the trend? No, not at all, right?
Yeah, as long as the market stays above 2,800, I'm still bullish on the market. I've been a cautious bull. You've been a cautious bull for the last few months, to be perfectly honest with you. Ever since we started breaking back out above resistance at higher highs in, May and June, the market this month so far, in July, I know we're starting August here, but in July, the market had the best month of the year so far. The markets are up, 3% on the Dow, 5% on the S&P, 8-10% on the Russell and the NASDAQ this year so far. We still got 5 months to go. It's been a really good year, even though it's been bumpy so far year to date. We've had a couple spouts of up and down nature. I mean, if you just look at the pure numbers from an economic perspective or the pure numbers from a market price perspective, I mean, there's every reason to be bullish and to remain bullish. I think from a technical perspective, though, we've identified this 2,800 level is fairly important for the market. And as long as the market stays above 2,800 on the ES contract, I'm going to be some degree bullish.
Yeah, me too. That's kind of where my line in the sand from a swing trade perspective. From a fundamental perspective, I'm still short-term bullish. As long as we have GDP at 4%, we can talk all about the expectations, all that, but employment where it is and all that, the economy does have strong indicators internally. You can't really debate numbers from that regard. Now, there's risk, like we've always talked about. A lot of that risk is measured in the volatility index. Matt, VIX is actually up just a little bit here today, 13.52. Nothing to see here. I would expect a higher VIX, in front of assumed risk from China and the Fed and all that kind of stuff. The fact that we're not even rallying at all, Matt, tells me what institutions think about risk in the market today. Moving on to, let's go to the CL contract. I think it's a real major story here today. Matt, you've been bullish on crude oil. The inventory report came out like it always does on Wednesday. They saw a build in supply instead of a draw in supply based on the expectation. And crude oil is, predictably down 1.37% here. When you've got these reports, in the last couple of weeks, we've been doing these shows during, about that time in the morning. And I know you're not going to change your overall position, but when you see two red candles in a row, does that make you come off of the bull call, or are you still staying with that?
No, I got nervous when it hit 70. We were doing the show on Friday. We did the show on Monday, and on Monday we were talking about this crude oil, and you were talking about how to finding an area to get in, and we were talking about how there is no area to get in right here. There's too much convolution right here from a technical perspective. You made the suggestion on Monday to roll it into a bull call spread. I did that. I'm not worried about it. As long as it stays above its support level, I'm going to stay in the trade.
Yep. 70 is what you pinned down a couple of days ago. It hit there twice. Got a little red doji. Where's your stop going to be placed here? Are you looking at that 66 or just a little below that?
A little below 66 is where I'd put a stop.
Yeah. So much of what's going on with crude, obviously, is the inventories numbers, but also global demand and what's going on with risk. The dollar is going to be key and in focus here today. Let's move on to gold.
Very quickly on crude oil, very quickly, though. And this is something we talk about. This trade may not work out for me, and I'm okay with that. But this trade may not work out for me. But I'm not going to overreact to a couple days of negative news as long as it stays above our technical conditions. The reason I got into the trade at the pivot at 66 is still legit today, despite the fact that it didn't get above 70. And so I'm not going to get out of the trade just because it didn't work out 100% how I expected it to make, because the trade is still legit today as it was a week and a half ago. Obviously, I'm a little concerned about it, more than I was, say, a week ago, but I'm still not going to get out of the trade simply because it didn't go up without any down days.
Yeah. I mean, that's the whole thing about the way that you mentor and coach and what we know about markets, Matt. We don't know the future in any of these trading strategies. What we do know is probability. We know the current information. We know what's in front of us. We assess it. We apply our rules. We apply our system. And then we try to do the best we can to trade unemotionally and within our rules. That's kind of the whole thing about having community and discipline and trading rules and trading strategies. Crude oil, we'll obviously need to revisit this through the week. Every day we look at crude oil for a reason. I still haven't touched it.
Well, there's no trade here.
Yeah,
there's no trade here.
I got nothing on this one.
There is no directional trade here at this point. But again, it doesn't change the fact that it was a legit trade when I got in at the time, and it hasn't changed the parameters of the trade when I made the trade. So even though there's not a legitimate trade here, I'm still not going to get out because the trade's still working.
Interesting. And it's a small candle. I mean, if you think about it, one of the things I always look at is not just the color of the candle. That is first, the size, the duration as well. That is a pretty small candle for crude oil. The red candle yesterday was more concerning than even today, in my opinion. It hit 70 and it actually pivot triggered on that.
That was dollar strength. That was dollar strength against the yen.
Correct. And so the size of this sell-off doesn't have me thinking major correction. It has me thinking reaction.
And think about it, Tim. I mean, when you just think about this as one trade, you might overreact to that. But think about what I just said. That was dollar reaction to the strength of the dollar against the yen. Well, in the Forex report, Tim, I went long on the dollar against the yen. So that benefited me in that capacity, offset some of the risk I had in crude. And that's kind of what I was talking about in that Forex report is basically intermarket analysis and how these things, they either offset one another, aid one another, whatever the case might be. But if you just look at this trade in one single aspect, yes, it's changing. But again, you got to think about why it's changing and how you can benefit yourself as a trader in those other changing environments like the dollar versus the yen.
I used an analogy this morning in our coaches lounge to kind of teach what trading was. And the way you just described it really fits to me. I called it a turn-based resource game, right? So every day you wake up, you approach the market, you log in, you take your turn, you move your money around, you apply your rules, you find a new strategy, you move on, and then you come back tomorrow and do the same thing. You like it? I love your reaction.
I'm thinking you've been playing too much polytopia. That's what I'm thinking. Turn-based resource game, and you just started playing a turn-based resource game, and yeah, it's a good analogy. I like it. You come in there, you reposition your trades, you click the end of the turn, and then you wait till the other guy clicks his button. So yeah, I like the analogy, but I just know where that analogy is coming from.
Well, there's nothing wrong with that. I mean, first of all, everybody needs a game in their life at some level, right?
Well, you're playing not the 11 against me, so I'm not criticizing.
Not the 11 hours I see. I read a study. I put it on Facebook today. 11 hours is the amount of entertainment that the average American consumes every day.
11 hours?
Yeah.
Think about that. 11 hours of entertainment every single day.
Sleeping 7-8 hours a day. That means you got 5 hours of shower, food, doing something. I mean, come on.
When do we work?
Who knows? They're probably consuming entertainment at work, Matt, is what it comes down to.
No, that's my point. I mean, the math doesn't work out. If you're sleeping seven hours a day and you're getting entertained 11 hours a day, that's 6 hours left to work. An hour in a commute, one way or the other. Yeah.
When crude oil is pivoting like this, by the way, instead of trading crude oil down, I might find something bearish in the energy sector that was in a better trend that I'd be more willing to play. So sometimes you use the information from one of the major commodities or indexes or whatever to go find different stocks. XLE hitting resistance, pivoting, that's a more willing bearish chart. And you wouldn't even be bearish necessarily on the whole index or the ETF. You'd have to go find an individual company to play. It's just that deductive reasoning type thing that happens when you're trading a lot.
Well, I mean, if the equation goes crude's down, energy's getting spanked, yes, let me go find some energy stocks. It's when we do this halftime report, it's two brothers talking trading, no doubt about that. But what we're really doing is we're doing daily routine is what we're really doing. I mean, and when you're doing your daily routine, it's all about generating ideas. And an idea, crude's down, energy's getting just absolutely spanked here today. The idea that I want to do is I want to go look at the heat map. I want to go look at the heat map to see what energy stocks are getting absolutely pummeled, pulling up the heat map here. And as you can see, basic materials getting beat up really hard today. Oil and gas down really hard. Apache, Anadarko, Egg, Apache, Marathon Oil, all down 3, 4, 5% respectively. If you kind of look at this, you can kind of see all of the trends here that are kind of looking at breaking support just from a line perspective. I guarantee if we spent the next 30 minutes going through every one of these energy stocks, Tim, you can find probably 5 or 6 really good bearish trades. And that all is generated based on ideas just on crude oil, energy down, basic materials down. Let's go look at those stocks and see what they're doing. And maybe that brings us to a shorting opportunity.
Check out Alcoa, AA, basic materials. But while you were doing that, I also clicked on Finviz, did the same thing.
Yeah, Barry obviously got beat up on the earnings. Bear retracement coming back up into resistance, pivoting back down. Yeah, I mean that's not exactly a great swing trading stock in Alcoa, but it is a good swing trading setup.
Yeah, the thing about trading, it doesn't have to be. It shouldn't be hard.
No.
The hardest part of trading is being disciplined enough to apply your rules and just kind of do it every day without emotion about the money going up and down, right? Mm-hmm. That's why every great trading book starts with mindset, Matt. The mechanics of trading, finding good entry points, just takes consistency and discipline, and also you have to be open-minded to see what's in front of you and actually react to it. When somebody comes into a day and they're just aggressively bullish on materials, maybe they just love it, right? Mm-hmm. And then gold is going down or materials are going down, energy is going down, and they can't respond to that. They get stuck on their own personal opinion. And then that's where mistakes can happen. And Cody, your audio just froze on me. Check that. And I'm just going to keep talking while you get that. I know that there we are. There's screen share, Miami Dolphins. We're getting closer to that mustache, young man. I don't know. I can see it. I can see that beard coming in. We're getting a lot closer to that mustache. I guarantee it.
All right. I switched it to my Logitech one. That should help.
That works. Yeah, I can hear you good. Okay, so what we were saying, Matt, is usually where people make mistakes is when they get stuck on opinions that can't come off of them based on what's in front of them, right? Mm-hmm. And that's why you don't have to develop an opinion for next year on the market. You have to trade day by day by day as the information's coming in.
Well, as a new trader, there's so much things that people have to work on. But I think one of the things that people need to work on the most is just being consistent with their daily routine. And that's why this halftime report is so important for those new traders, being able to have somebody walk them through daily routine and what we go through on a daily basis. I think is extremely helpful.
Yeah, I agree with that. So we'll come back to trades here in a minute. Maybe one of those materials or energy stocks will kick in. Go and check out the gold market, the metals. If the market assumed risk, you would always say they would probably go into the gold market and buy. And actually, Matt, you have a potential setup with a trigger developing here. This is a tricky one. And, you're a technician. You can go as deep as you want to on this. If you're looking to play gold bearish, do you trigger at 1220, 1210? Which candle? There's a ton of stuff in there that makes it difficult to figure that exact price point out.
This is very, very difficult because it goes back to the eternal debate, wick or body, right? How many times we've had that debate? Where do you identify that support level? Do you identify it at the bottom of the lowest wick? Do you identify it at the body? And to me, this is a very subjective opinion. It's based on, your own personal bias. What I've always tried to do, Tim, is let the data do the talking. I got one data point all the way down here at 1210. That is an intraday support level, no doubt about it, but that is an intraday support level. Intraday support levels are not that strong, right? They
Mhm.
stop the momentum briefly, but then they're very easily broken. When I'm looking at this as a support level, number one, I'm not going to trade directionally in this pattern. That is just stagnation, little up, little down, little up, little down. If you're going to trade bearish, you got to pick a support level that you feel is a strong support level to calculate on your breakdown. To me, that number is 1220. 1220 for me, a close below 1220. Number one, we have not seen a close below 1220 in this recent technical pattern. It is tested underneath 1220 multiple different times, one on the 19th, one on the 20th, one on the 24th. It's hit into that 1220 level many, many times. As you can see, kind of looking at here, 1220 support, you just got to kind of give that some degree of support level. You got something 1216, 1218, 1220. To me, you got to give that a number. I don't care what number you give that, but you got to say where that support level is, whether it's 1220, 1218, or 1216, or 1210. For me, 1220 makes the most sense. But I could certainly understand somebody saying, well, Matt, when I'm looking at the hour chart, you got support here at 1218 and you got support here down all the way down at 1210. And I would say, yeah, you do. That's fine. I'm not going to argue with that. But for me, the breakdown point would be 1220. So a close, and it couldn't be a test, Tim. It couldn't test like it did back on this candle or this candle. It's not if it goes under 1220, it's got to close under 1220. So I wouldn't ever make a trade on a day like today because it's not going to close underneath 1220. I'm going to wait for it to close underneath 1220, and then I'm going to get into it.
And obviously, if you trade the futures market, the GC is fine. There's also a mini gold contract for sizing. If you've got a smaller account, the YG, I believe, is what that is. But GLD is probably the better product for most of our audience, Matt, the ETF product. And, same kind of analysis. You see little minor gaps, but it's the same thing we were talking about a few days ago with the FXY instead of the JPY. And that's because it's a global 24-hour-a-day market. These gaps don't throw you off of trading GLD, correct, Matt?
No, it's a 24-hour marketplace. So there are sometimes, we call them gappers. There are some times where the gappers will stop us, and that's usually a U.S. stock that is illiquid, that gaps every day because it's illiquid. When you're dealing with some of these international 24-hour markets, you're going to see this. We saw this with FXY when we were looking at the Japanese yen pair. No, that's a 24-hour market that gets priced into the market every single day. It's a very normal gap.
Give me a quick look at Bitcoin before we get into dollar analysis, then into trades. XBT, little pullback. Everybody got excited and fired up, and now we're coming back here a little bit. Could be a retracement, kiss hello kind of thing. We'll wait and see. That old resistance, about 6,800. Matt, if it's set up perfectly, pull back, pivot, trigger, are you ever going to get back into Bitcoin?
I don't know.
Yeah.
I don't know.
We'll revisit
it. I'm open-minded to it. I am open-minded to it, and I made money on Bitcoin. You and I were early adopters of Bitcoin before anybody even knew what Bitcoin was, right? Mm-hmm. We were all over Bitcoin after Mt. Gox in October of 2013, making our first trade on Bitcoin in 2014, 2015.
By the way, my favorite acronym ever. Do you know what Mt. Gox stands for?
Yeah, it's Magic the Gathering. It was an exchange for Magic the Gathering.
Yeah.
which makes perfect sense when you talk about the evolution of a new technology that could absolutely change society in the blockchain technology. And the biggest exchange at the time was literally a gaming card exchange.
So their website started out as a game card exchange, Magic the Gathering, and they couldn't make enough money doing that. So they started doing Bitcoin. That's the evolution of Bitcoin. People see Bitcoin now as this well-entrenched, established cryptocurrency. It's in the lexicon. It's not where its beginnings were. Yeah.
really, really new.
Yeah.
If Bitcoin, listen, I'll just say this about Bitcoin. If Bitcoin is legit, there are going to be a million different trading opportunities on that over the next 20 years. Would you agree with that?
Yeah. Yeah, so for sure.
I don't feel the desire, the need to jump into something when I still for myself, and I'm not trying to offend any of the Bitcoin lovers, but I still, for myself, have not decided if this is a legitimate investing opportunity. Just yesterday, a prize-winning Nobel Prize-winning economist came out and said it could be a Ponzi scheme that has zero potential in it. And Tim, I agree with that. I agree with it has zero potential. I don't think it's a Ponzi scheme, but I do think it does have zero potential. I cannot be convinced that Bitcoin is still around in 10 years from now. When I get convinced on that, I might invest in it again. As a trader, of course, I'll trade anything. But as an investor, no, I will not invest in anything that I don't think that I don't know for certain that if it's going to be around. And so for me as an investor, I don't know if it does turn legit and becomes universally accepted. Yeah, I'll miss out on the initial millions in potential gains. But you know what, Tim, if it does do that, I will trade that sucker every day for the rest of my life and be just fine.
Yeah, that's the way these products work. And Bitcoin for another day. We've got other priorities, obviously. You're not going to pull the trigger on something like that, even at this point anyway, no matter what. That red candle is very bearish and it's going to pull back here.
It's still bullish, though. Short term, still bullish.
I agree with that. It's above the moving averages. It had that real strong push up. Technically, you would like a pullback into that 7,000 type level.
If you're a buyer waiting for an opportunity to buy Bitcoin because you might have, and I don't want to say might have, I would say you did miss this. Almost everybody missed this movement. And once it got overextended, you're like, oh, I should have done this. So if you are looking to get into Bitcoin over the next few days, maybe a week, you might get a very good bullish pivot opportunity somewhere around this 7,500 to 7,000 mark. You got a high base type situation right here. It consolidated at 7,500 over here. You certainly could see a pivot point at 7,500. I would, from a pure market technician perspective, a pivot down here around 7,000, that would be a really good buying signal from a bull perspective.
Yeah, very good. So now we got to talk about the dollar, Apple, and some of our trades. We can go anywhere you want to go next. I think the dollar is probably going to be an important conversation. Until the Fed announcement, who cares, quite frankly. Number two is it's in the middle of the range, and I don't expect it to break and run one way or the other. Well, maybe in September, maybe, right, at some point.
Yeah. Not even in September. I said this in the Forex report. I talked about it on our Monday halftime report. The event that I'm looking at here, Tim, is not today, not even in September. The event I'm looking at is right here, the official bank rate out of the Bank of London tomorrow morning at 7 a.m. Eastern Standard Time. That's the one I'm personally looking forward to, because when you're looking at the official bank rate announcement here, that thing is expected to increase. The Bank of London is expected to increase by 0.25%. That is a big deal. And if they come in and they have an announcement that they're raising interest rates and they're looking at, raising even more in the future because of what the U.S. is doing, normalizing interest rates, that certainly could move the dollar quite a bit. So even though today, I don't expect a lot of price movement today. I expect a little bit of price movement today, but I am looking at that Bank of London tomorrow, and I am looking at the unemployment report on Friday as two of the bigger indicators this week that could move the currency market.
Yeah, I agree. Here's the thing about the Bank of England and the pound. Obviously, everything going on with Brexit, the pound has been very volatile for 2 or 3 years now, Matt. Who knows what's going to happen with that? You had a really good call on that last weekend with the pound, euro, dollar crosses in all kinds of different equations. When you're in a swing trade going into an event like that, Matt, let's say that you were short the pound and it hasn't really developed where you want yet. Do you hold through that event or do you take it off and then reissue?
I would hold through the FOMC because I'm not expecting a lot of movement, but I will not hold that through the Bank of London announcement. Not a swing trade. I would most likely set that up as a secondary price movement off the announcement. So we've talked about it in the past where you let the announcement happen. You let the volatility happen. You let that first 30 minutes happen. And then you trade the secondary price movement, okay? That first price movement on an FOMC event, an earnings, an unemployment event, you name it, that first price movement off a major economic report is so volatile, T. It drives up, it drives down. You can try to K trade this, but it just stop hunts. It's dominated by the professionals and it's dominated by the algorithms, right? That's all algorithm trading. You wait for that volatility to subside, and then you trade that secondary price movement once that intraday trend is established. So when I'm looking at, for example, you know, the trade I was looking at was the Euro GBP pair. Triggered earlier this week, obviously coming down a little bit, a lot of that due to the strength of the dollar and whatnot, but still a profitable trade. But the reality is you got this major event tomorrow that's going to impact this currency, the British pound currency. You can't hold a swing trade through that major announcement, Tim. It's too volatile. Wait for the announcement, then get in on the secondary intraday price movement.
Yeah. Obviously, Forex markets are the kind of thing where you have to be aware of when these economic reports come in. The economic calendar over at Forex Factory has all the global currencies listed, the major ones at least, all 8 of them. And so you can get all of those different currencies when you're filtering the pound, the yen, the dollar, you know, the major currencies. Matt, Apple, got to talk about that. Got some trade setups I want to talk about. Also out there, if you're listening and you're watching, everybody say hello in the chat. And good morning, good afternoon to everybody, wherever you're at. Give us a quick thumbs up and a like and make sure that you are getting this out there. We love doing these reports each and every day and help us get the word out. That'd be very much appreciated. Apple Computer, Matt, they crushed it. Crushed it. Company's on the way to $200 billion, or $1 trillion, I should say. At $200 a share, here's a fundamental question I asked our audience last night in our coaches show with our premium community. I said, is it an undervalued, overvalued, or fairly valued stock? Now, I want to set this up for you a little bit. The PE ratio on Apple is 18. The PE ratio on technology is 33. The PE ratio on the FANG stocks tend to be extreme, right? Even Google at 33 is about the lowest of all those. Netflix and Amazon and all the others is much, much higher. If Apple just caught up to the PE ratio of tech, it would be a $330 stock.
Mm-hmm.
Are you a buyer here?
To think about.
Yeah.
It's amazing to think about. I was looking, like, sometimes I always come back to the new traders, but sometimes new traders are like, oh, it can't go up. It can't go up. It can't go up. It's too high. It's too high. It's too high. And I'm like, that's not how inflation works. It continually goes up. You look at Apple, I believe I read today, Apple's got to get to 206 to be the first $1 trillion company. 5 points away from that, two and a half point movement. It could do it by the end of the week if you keep seeing this bullish momentum in Apple going. I mean, Tim, I was looking at the last 20 years of Apple's earnings reports from a revenue perspective, and Tim, it was astonishing. It was astonishing to see their revenues from a yearly perspective to go from a $2 billion company to a 3 to a 4 to a 5 to a 6 to an 8 to a 10 to an 8 to a 12 to a 20. But once they introduced that iPhone, oh my Lord, that thing just started skyrocketing from a revenue perspective. Tim, they're going to cash over $200 billion in revenue this year.
I read the most interesting article about the iPhone as well.
Hold on, T, real quick. Think about that number. $200 billion every single year on a $1 trillion company with an 18 PE ratio that is set up to be a rock star. Yeah, it can continue to go up from here. There's no doubt.
I'm a bull. I'm a buyer. I still like it. I don't even mind the idea of trying to build something conceptually and with risk aversion, even right here on the gap out. Now, most likely the best way to play it is to wait for a little gap fill over the next week or so, kind of like Google did. Just quickly peek at Google chart and come back to Apple because I want to have a deeper conversation on this. Like when Google gapped out on earnings, you knew that it was going to backfill at some point. So the entry on Apple may be today if you have a way to trade that and control risk in a spread, but it might not be for a week or so once it backfills into that gap. Man.
The difference I see on Google, though, was on the price on the gap, Tim. I mean, Google gapped out on strong revenue, strong guidance. It's a slightly overpriced stock than say Apple is, but immediately upon the gap out, it started profit taking, right? Mm-hmm. That would show me a little bit of weakness coming after the earnings, people basically locking in profits. So a gap fill on that one was not too surprising, a little bit of an exhaustion gap. And again, the difference between a runaway gap and an exhaustion gap are very, very, very similar. There's not a whole lot of differences, but one of those differences are if it starts selling upon the breakout on the gap, That's a profit taking signal. I'm looking at Apple here, Tim. Apple gapped out, traded slightly less, but then started showing strength intraday. That's something that's a little bit different than we saw with Google, with Apple showing strength intraday, strength coming into the close. A close above 200, in my estimation, is a very bullish signal.
I agree. Yeah, and
honestly, T, you know what it feels like? It just feels like like the entire market wants this raise to $1 trillion. It's like they want it over, so they're just going to do it.
Well, it's become part of the thought and the process and the psychology in the market. Many times, in fact, that's just mass psychology, right? I would be shocked if Apple does not hit $1 trillion at some point, right? And in the very short term, which means that I believe that Apple's going to be at 2.5, 2.10 within the next month or two, right? Yeah. The actual price action could backfill trigger, could just run right to it. Heck, it could be there by Friday if you have a favorable reaction to the Fed and unemployment. It is one of those trades, though. Your reward to risk from a swing trade is probably thrown off right here.
Well, you're not going to be able to swing trade it in a standard swing trade where you put a stop loss underneath the support level. I think if you do play this right here, your stop loss is right underneath the low of the day. That's what I think. At that point, you still got a pretty good reward to risk ratio. You can't get a stop loss all the way down and make a reward to risk ratio work right here. If your analysis is, if it starts to fill the gap, I want to get out, that's still a pretty good reward to risk ratio by getting in above 200, putting a stop loss right underneath the gap range. If it starts to fill that gap range, you get out of it. If it doesn't, you still have the growth potential.
Well, and 4 to 6 month options matter, relatively cheap actually on Apple. They didn't get the volatility build that you would expect. Now that it's crushed out, I was looking at a bull call spread on that. Look at that. You can go to November. I actually was looking at January, the 170s. Because if I was going to trade this breakout, I probably wouldn't even try to swing trade it. I would probably do it as a position trade with some kind of bull call or some version of a vertical spread like that, and trade it directionally. These are not bad options. The 200 option, $11 on a $200 stock, that's not too bad. It's 5% for 6 months. And then your 220, let's see here, what's that delta split? 27?
26.
You're coming in at, that's 40% of the spread. That's very typical. It's a fairly priced option, right?
It's a fairly priced option. It's a good play. I mean, you're going out to January, giving yourself a lot of time. Data's not going to impact that trade very much. You're going to lose $3 a day on the $200 option. You're gaining what would that be, $2 on the 220 option, which basically means you're mitigating theta, so you're not have to worry about the theta decay here. Mm-hmm. It's a risk adverse trade. It's something that you can stay in as long as it stays above the gap range.
Yeah, I agree. And many times when you're doing this on a daily basis, Matt, you might buy the one option on an intraday trigger point and then sell the other one option conversely. If you're a new trader, you just kind of build it all as one spread. Mm-hmm. But many traders will layer into that as the day is developing. You're adding a variable there, which could either benefit or hurt you, but you're either betting on yourself or not on your day trading skills.
And the reality, though, is, when you're doing the bull call spread, you're buying a good option at the money with the delta of 0.50. You're selling it out of the money option with a bad contract with a delta of somewhere around 0.25. You want a net delta somewhere in that 0.25 to 0.30 range. That's why I picked the strikes I did. Looking at the volatility, it's a buyer's market. This makes sense to me.
Yeah, I like it. And quite frankly, the numbers were incredible. They beat on top line, they beat on bottom line. Their iPhone sales were strong. The PE ratio is still very favorable. The multiple for me is, one of those things where you got to be attracted to Apple here. And I love the gap out. I would have expected the NQ and the tech sector to follow stronger than this, though. Apple by market cap and by weighting of those indexes, Matt, the NQ is not up that much. Apple's up 5% and the NQ is only flat. That doesn't make sense to me.
You got more decliners than you do advancers today, and that's obviously offsetting Apple. Like I said, if it wasn't for the announcement coming out of the Trump administration that we were looking at $200 billion more in tariffs on China, and that was in the news headlines today, this market would be skyrocketing.
For sure. A couple of trade setups that I'm interested in. Number one, I got a bear setup on AVGO. I got a bull setup on Grub. Let's take a look at the AVGO. By the way, beautiful. pivot, trigger, the whole thing.
Mhm.
Now, I already ran the numbers on this one this morning, Matt, and I was comparing the bull or the bear call and the bear put, and I was doing some risk graph analysis on which one made more sense. And I came to the conclusion for me that the bear put was a better way to play this one, just personally. When you are looking at a setup, how do you decide what strategy to play this? Because you could short the stock, you could buy a put, you could do a bear put,
For me,
a bear call.
And this is just me. This is my bias. This isn't like hard and fast empirical evidence and whatnot. For me, it determines on my bias, right? If I'm if I'm slightly bearish on this, I might look at a bear put spread or a bear call spread, right? If I'm very bearish, I might just buy a put option just to take advantage of the aggressiveness. So it depends on how aggressive versus how conservative I want to be playing a stock. Usually speaking, the conversation for me when you're dealing with stocks is usually, are you going delta or are you going theta? That's really the debate for me. If you want to be aggressive, you go delta. If you want to be a little bit more conservative, you go theta. If delta is usually you have to put up more money, theta you have to put up less money typically. Theta, you get more range. You make it. You take advantage of the time decay of the value of the option. You don't have to be 100% correct to be profitable on the trade. For example, if you're looking at two things, and we like to debate these two things and then throw it out. So for everybody listening here, I'm going to prep two trades here. I'm going to prep a bear put spread, and I'm going to prep a bear call spread. The bear call spread is a cash flow theta strategy. The bear put spread is a delta-based swing trading strategy, okay? The bear call is conservative in nature because it's a cash flow system. The bear put is more aggressive in nature. You have to be right on your direction. You do not have to be right on your direction to make money on the bear call. You have to be right on your direction to make money on the bear put. Now, the bear call, you'll have a higher probability, but you'll make less money. The bear put, you'll have a lower probability, but you have an open-ended risk graph where you can make more money. So I'm going to come here to the Analyze tab here on AVGO, Tim, and I'm going to prep the bear call first. Now, whenever you deal with the options market, and you guys have heard this from me many, many times, you have two clauses in that contract. You have your time clause, you have your price clause. Time, price, time, price, time, price. So the contract in the options market reads that you have the right to buy or sell an option at a specific price on or before a specific date. That is your set time and your set price. Set time is theta, set price is delta. So our time rule on the bear call spread is we're going to go out closest to 30 days. So on the bear call, obviously I'm working on call side. Now I got to pick my price, Tim. My price, I start with a 0.20 delta. That is right here at the 235 strike price. Now, whenever I'm doing the one of these credit spreads, I'm going to start with my delta rule. It's at 235. I want to come peek at the chart here at 235 and say, you know, Tim, is that a level that I want to sell above? Or excuse me, that I want to sell below here? And there's a really good support level right here at 235 to stop it from going, resistance level from stopping it to go further. I would have no problem if somebody said, you know, Matt, I kind of feel like selling that 240 up here is a little better. It gives me a little bit better range. You're above the support, the resistance level at 235. You're above the resistance level at 240. So to me, to be a little bit more conservative on that on AVGO, I'm going to go down to the 20 delta, but then I'm going to offset it and go down to the 14 delta solely because I wanted to get above those resistance levels, Tim. Now I'm going to right click and I'm just going to price out one contract. Now, Tim, we got a $2.50 spread on a $220 stock. We got to open it up. Widen that spread. So we're going to widen that spread to 245. That is a $5 spread. Now, I'm getting $45 on a $5 spread. I'm getting right about 9% with 86% probability. I am going to make
What's the delta on that?
Say again, T?
What was the delta on the short leg?
Delta was 14.
So here's the thing, guys, and let me back this up a little bit. This is fantastic. You'll learn to do math in your head, but not when you're new. Use a spreadsheet tool. Matt, there's a wonderful tool for people to help them kind of organize and structure this on our trade journals. And in fact, on the Trade Center over at Tackle Trading, there's a new tab over there by the way. So to do the math Matt's doing right now, if you click on Trade Center, you'll see it in the menu on the left. It says trade journals. This will help you do what Matt is doing quickly, because trading, I mean, Matt, you've been doing this 13 years, obviously. A beginner having a structured theta research tool right there, okay, that button, go up just right there, where they could download this and go through this step by step and watch the tutorial on how that works is probably very important for a beginner, don't you think?
Oh yeah, absolutely. For a beginner, for a veteran, you should always journal your trades and do your research. And if I was pricing in 10 different bull puts versus bear calls versus naked puts versus covered calls, I would definitely fill out the journal. And you know what, T, this trade journal, I mean, anybody can get access to our trade journal, right? And so if you're not a member of the pro community yet, you should be, number one. But if you're not, you can still get access to those trade journals. That's what we do at Tackle Trading, guys. We take care of our entire community, every single buddy. We try to do whatever we can for all new traders in our community.
But that's a different step in analysis. I just wanted to point that out and kind of step back a little bit, because Matt, here's the thing. I already know that's a 9% return on, what was the exact short delta?
The short delta was a 14 delta. So you're talking and
60, 70% ROID, right?
Okay, it's going to be about a 70% ROID,
which is fine. You know, and when you know that you want to play, that's a passable trade. And when you know you want to trade AVGO, you can just do the math in front of you in the system, right?
It might even be upwards of 75% on the ROID because it's such a low delta, right?
Yeah.
So ROID is an indicator that I created many years ago. And basically the reason I created ROID was my frustration and how people used to teach credit spreads. And how people used to teach credit spreads, they would say, well, if you're getting 10% of the spread, that's a good trade. And I'm thinking, isn't there a probability analysis on this, right? If you're getting 10% of the spread with a 20 delta and 10% of the spread versus a 10 delta, those two are not even remotely close to the same quality of trade. Would you agree?
Correct.
Yeah. So what I did was I took ROI divided by delta, created calculations to determine what is a good credit spread and what is not a good credit spread. And that's what ROID is. And it's on the spreadsheet. So all you have to do is fill out the spreadsheet and then it tells you what the ROID is. But I'll tell you, it's somewhere between 70 and 75. Anything between 60 and 70 on the ROID is an average credit spread. Anything above 80 is a really good credit spread. Anything below 60 is no-go zone. So this one is a good credit spread, right? But the base numbers here, as long as this puppy, which our projection is down here, no doubt about it, it's currently $217. As long as this bad boy stays below 240, we're going to be profitable on that trade. We're going to make 9%. And I want to throw it out to everybody watching here. Is making 9% on 86% probability over 30 days. Is that a good trade? And Tim, I think anybody would say yes. Making 9% return in 30 days is a good trade.
Yeah, I agree. And I still thought the debit spread was better.
Okay. Now, the debit spread, though, because we can only make what we sold in the credit spread, right? We can only make that $45 per contract. We can't make more than $45 per contract. And so if you want to be more aggressive at that point, then you look at the debit spread on the bear put side. And that trade, basically, you're looking at this. So we're looking at the put side.
Go back to the trade tab for a second.
Is our days.
Go kick the credit spread into the Analyze tab so that we can cross compare them. So where you had that order for the credit spread, find it for me.
I think I deleted it, but.
And we can always recreate it. So build the bear call and the bear put so we can compare the two, right? You know, so we're going to sell that vertical credit. Now you've got cushion and you've got a good design there on that credit, 9% on a low delta. In fact, I think that delta was not 14. It might've been higher than that, by the way.
No, it's 14.
Yeah.
Yeah, it was 14 2 seconds ago. It's 14 today.
Okay, 14, 9% on 14. I was looking at a different number there. I had to measure twice, cut once, Matt. You know, it is what it is. Come down here to the bear put now for October.
Now, the first thing you have to select is the amount of time left, right? Now, when you're selling cash flow techniques, ladies and gentlemen, you want to work short time. You want to work within that last 30 days, right? You want to take advantage of theta. Theta is a risk to the buyers. It's a benefit to the sellers. So if you're a seller, if we're on the opposite side and we're buyers here, We want to mitigate the theta risk by going out more time. Now, typically on some type of swing trading setup, Tim, typically I'll work outside the 60-day number. So here I got 79 days left in the contract. It's in October. Now, the second thing I have to select is your delta. Now, when you're doing a bear put spread, you want to buy at the money. Current price 217.86. At the money option is the 220 put option. It has a delta of 0.51. So I'm going to right click, buy, vertical, and I'm going to come and change the one I'm selling to the 0.25 delta, somewhere around that 0.25. And that is the $200 strike price right there. I changed the one I'm selling to the $200 strike price. I have a net debit, Tim, of $8. And if you're looking at if your projection is it's going to go back down to this support level right here at 200, right where we sold, that's a really good target potential, Tim. So if our analysis is it's going to go down to 200, we're going to make about $485 on that trade versus $45 on the credit spread.
Where would you put a stop loss on that?
Stop loss would have.
This is more of a position trade, by the way. You know, even at two, maybe a swing position.
Yeah, it's more of a swing.
Yeah,
it's more of a swing. But on any one of these trades, I mean, you're talking somewhere around 231. So you have $300 risk for $490 potential return.
Sure. And to compare apples to apples, make the credit spread 2 contracts. Because you got $1,000 on the one. No, that's the debit. Leave the one on the debit. The other one is a $500 margin. So, and the credit just went up a nickel. So that actually helps your analysis.
So we're getting $100 off $1,000, which is 10% ROI with 86% probability. We can only make the $100. We have an upwards risk of $1,000 here. Okay. On the debit trade, our max risk is what we pay, $795 if it gaps against us. But our risk on the risk graph is $300, and we have a max potential of $490. And I would say you have a 55% probability of being successful on that trade.
And look at the Greeks here, Matt. 25 delta negative. Theta is -1 if you put the trade on today. You know, obviously you're going to carry a slight negative theta when you build it. Whereas the credit spread has an 8 delta negative. Theta is +3. So you're getting less delta on the credit, but more theta for cash flow. Whereas on the debit, you're getting more delta, but no theta. In fact, you have a -1 theta. Now, if the purpose of the trade is independent just to make money on its own, not in the context of a larger portfolio, you have different analysis. So let's say that we don't have any other trades, that we were just looking at this one and we had to make a decision just on its own merit. What would be the choice for you?
If I'm, first of all, I'm going to make this trade. That's number one. I'm not putting a stop loss above 230. I am going to do the bear put here. Okay. I think because of the directional bias being very strong, the pivot underneath 220, I'm seeing a little bit of an intraday support level here at 220, Tim, right here in this 220 to 222. In fact, once I dropped it down into the intraday, you see how strong that 222 level is right here. I think you don't, to me, you probably don't have to put that stop above 230. You just got to put that stop above 220 here. And if you put that stop, say at 223 on that one, it makes the reward versus risk tremendously better.
Very strong.
490 potential return for a $125 potential risk. I like that. And the reason I like that trade better than the credit spread, typically, I know if I went out and priced out 10 more bear calls, Tim, I could get a better ROI than what I'm getting on AVGO. But what I don't know is if I can find a better technical setup with a better reward to risk ratio that I like. And that's why I like the bear put on AVGO.
You know, I will give everybody out there a thought. Number one is you've got to learn your strategies well enough to where you can cross compare them. Okay. In trading, there's a process to developing, and obviously you got to start with step one. That's just getting a routine. That's what this halftime show is, Matt. It's our routine as we go through the market step by step by step by step. AVGO happens to be a trade that I took. I did the debit spread myself, and My management would be somewhere in that 223 to 226 range. I don't know exactly. I don't have a stop loss set on it yet. I built the entry, and one of the reasons
I don't put
like
stops on. I put alerts. I don't put stops on spreads.
that's the way I play them too. But we watch the market every day. I get why somebody would have a stop if they're a 30-minute a day, go to work kind of trader, right?
Well, yeah, and we do have the benefit of sitting in front of our computers, as much as we want. Our commutes are the 30 feet from our bedroom to our home office, so it's we have that benefit of doing that. But even at that, Tim, a stop on a spread with two bid-ask spreads, and they can get widened in volatility moments. And if you do a stop on a spread or an option, make it contingent on the stock.
Contingent to a limit too.
Yeah.
There's a lot of variables. That's the kind of thing we actually did an hour on that in the coaches lounge the other day for the pro members at Tackle Trading, Matt. Some of those advanced techniques, I mean, you got to be able to go in and work with coaches one-on-one. There's one other reason why I like the debit. The reward to risk, independent on its own, even if AVGO was your only trade, I like that one better. But the other reason is, Matt, my portfolio needs more negative delta. And the debit has a higher negative delta rate to balance my portfolio naturally in this position. If I had a bear call, I'm not catching enough delta to bring me back to where I want to be. Does that make sense?
No, you're on the bear call, your delta is mitigated. On the bear put, your theta is mitigated. Yep. So, I mean, if you need more positive theta, then the bear call makes sense. If you need more negative delta, the bear put makes sense. That's in construction of a general overview portfolio, though. We're talking about this as a specific individual trade. And either way, I do like the bear put better.
By the way, we have a guest producer here on the show today, Cody, and he just put in a private chat. I feel like I'm being spoken to directly. Yes, part of this lesson, Cody, is for you, young man, because this is something I had to teach Cody today.
Well, I hope more than just Cody is getting something from this discussion. And for the team out there listening, guys, this is what we're trying to do. Is we're trying to get into the mindset of two traders having discussions about trades and how they process trades. And is this helping you guys kind of understanding the mindset of traders? And is this helping you do your daily routine on a daily basis? And if so, give us a nice little thumbs up. We like those thumbs up. It makes us feel warm and special and fuzzy and all that jazz.
Well, it also helps promote what we're doing here so that we can get a bigger audience and help more people, Matt. There's no doubt about it. And AVGO is one setup, not the only setup. I got two bullish ones I want to take a quick peek at. Number one is CRM, Matt. I like this one personally. That intraday pullback pivot, by the way, you're going to like that when you look at the intraday chart. That green candle's got you concerned, but we got to remember, market's flat, CRM's still up 1%. I love the trigger. It's not following through yet. It's got red candles. There is some risk in that position, but I like it. I like the company. I like the setup. I like the pivot. What's
like the company, like the CEO, like the setup. I got no problem on this. This is just the internal discussion on bull call versus straight call, in my estimation. Waiting for confirmation, but I love the setup. Obviously, this is market response. This was what the market was doing. This was based on, the Facebook, Netflix fiasco coming out of Amazon. That was all market kind of driven, slowing down, sitting on a 50-day moving average. I would like to see some confirmation above 140, Tim. But if it confirms above 140, you could definitely do a bull call spread on that, no doubt about that. And like I said, Mark Benioff is, in my estimation, one of the top 5 CEOs out there. Love how he runs his businesses. Love how he has his organization structured. Love everything about Salesforce. I think it's an absolutely fantastic, great company. I'd have no problem swing trading this or investing in it.
Take a look at Grub.
I'm not going to say glowing things about Grub, but I will say it's a good technical setup.
Well, breakout, pullback, pivot. I mean, this is what we look for, right? And you've got a trigger there on the candlestick there today, Matt. That's the kind of thing that you would take a picture and put in a textbook.
Yeah, after the earnings response?
Yeah.
I mean, that's textbook, brother. After the earnings response, textbook profit taking, coming down into a key level of old resistance, now new support, confirmation pivot. Yeah, definitely love that technical setup. Stop loss underneath 120. That's an easy one.
Yeah, I'm with you. So how do you do that? Same kind of thing. You got to apply your strategy system. We're not going to go through and build that one here today, but you got a couple of bull setups. You got the bear setup. The thing I've got to know, Matt, is are you playing Tesla yet? You gonna do Palladium first? We can do that.
Well, I just want to point Palladium out because I called Greg on Friday and said, Greg, you got to put Palladium on the bear commodity report. And Greg says, okay. That was the analysis. Loved it. Still love it today. Look for it from a bear standpoint, no doubt about that. But obviously the big dog of today is Tesla.
Mm-hmm.
How are you going to play this?
Inverted fly. I'm probably going to do that 10-point window we talked about the other day and do the inverted fly. It's a bi-directional earnings-based volatility trade, and it's good enough for me based on reward, risk, and numbers. I don't love it personally, but I think it's going to come in. I can't imagine Tesla's not gapping more than 10 points. Okay.
The market maker move has increased 5 points in the last day and a half.
Yeah, people are getting nervous.
People are getting nervous.
Yeah.
They're pricing it in. These options are priced to sell. They are so overpriced right now. I expect Tesla to move. I expect it to move more than the market maker move. We're looking at that. We priced this yesterday. We talked about it on the podcast on Thursday, so we don't have to prep it here. But I'm definitely doing the inverted fly. I like the 15-point spread on it a little bit more than the 10-point, Tim. Mm-hmm. Now, again, when we're talking about that spread, ladies and gentlemen, the spread is the difference between the body and your wings on the fly. So the body, you work at the money. That'd be the 295 put or the 295 call, okay? Your wings is what the spreads we're talking about. So Tim's talking about a 10-point spread one way and the other. I'm talking about a 15-point spread. Now, the difference is this. I'm going to get paid more money on the 15-point spread than Tim is, but Tim has a higher probability because it's more likely to move more than 10 points than it is 15 points. Would you agree with that?
Both are fine, by the way.
Well, no, they're both good. I'm just saying you have a higher probability of being profitable with the 10-point spread than I do with the 15-point spread.
Yeah.
But I like them both. I like them both. Construction of the trade. In fact, you could actually do, we'll do 295. Sell, butterfly, change that to a 15-point spread, 280 by 310, 249 on the credit.
Stop right there, though. Go back. I'll show you one of the reasons why waiting till this point can be a problem. Look at the NAP price there, Matt, at 50 cents.
I get it. You're dealing with some bid-ask.
You're dealing with some widespread. So you're essentially hoping that the market's going to fill you at that point, if you know what I mean. This is the debate we've been having all week. If you wait to get into these flies until last minute, you might miss your fill.
Yeah, but on this 295, it's got a real big wide bid-ask spread. The 52 delta, 49 delta, even the 47 delta. You can construct this trade to where it does work, T. Even if you do the 297 and a half strike price, you're going to get filled on that inverted fly today. You might have to reset the trade a couple times, but I have no doubt you can get filled on this today.
Change gamma to open interest or volume, either one or both. You can put them into both. And give me an OI and a volume. Put both of them in there. Okay. Tons of open interest and volume, even in the 9-day contracts. I'm looking at the spreads there, Matt. Out of the money, that 310 that you're going to play, that's only got a 30-cent window. Actually, that's actually more liquid than the 295 that you're looking at. There's a bigger spread, 1645 by 1740. You're looking at good volume on the 300 strike. See, the more people are playing it in the market, obviously it's more likely that you're going to get a fill at a midpoint. So sometimes you got to look at some of these numbers. The deep in the money option, and this may be, Matt, where the put option is more important to do than the call option.
See more volume on the put side.
Yeah, that's right.
Especially at that 295.
So you're more likely at that same pricing point, because it's the same risk graph, by the way.
It's the exact same trade.
Yeah.
You're getting a little less credit, 230.
But you're more likely to actually get 230 than the 250 that we would assume we're going to get on the call. Because on the call side, you've got illiquidity on that in the money option. Does that make sense?
No, it does. It does. I mean, the natural price on the call side is 50 cents. The natural price on the put side was $1.50. Much tighter bid-ask spread on the put side. This is definitely a put side trade. Now, again, I want to make a point. This is not a directional trade. There is no bias up or down. So even though we're working with put options, it is a bi-directional data strategy. We're expecting price movement one way or the other. You can use either call or put. From a liquidity perspective, Tim, you make a great point. It works better on the put side. I just priced it out. It works better on the put side.
I like it, guys. That has been our halftime show here, presented by Tackle Trading. Matt, we got a busy day here in front of us. We got meetings, we got things going on. The Fed meeting's here in 23 minutes. I mean, obviously, we're going to be watching the market. Guys, if anything happens, you're going to hear it from us first. Go follow us on Twitter, follow us on Facebook, any of the social channels.
At Trading Justice, at Tackle Trading, at Tim Justice Utah, at Matt Justice 13. Those are the 4 follows you want to make on Twitter.
Yeah, I wasn't that creative when I came up with my Twitter handle.
No, it's a ridiculous Twitter handle.
Hey, I like Utah, all right? It's my home.
Yeah, it just means every time I tag you, it takes up too many characters.
Oh, I don't think I can change the handle, dude.
Got a big announcement today as well. The latest edition of the Trading Justice newsletter is being released today. It's part 2 in system development. It is one of the best newsletters we've put out there at the Trading Justice podcast. Make sure you get over there to tradingjustice.com, sign up for that newsletter. We will send that newsletter to you in an email once you sign up for it. It is a free newsletter. In my estimation, all biased intended. It's the best newsletter out there. You can also become a pro member of Tackle Trading at tackletrading.com. You can get a 15-day free trial with no credit card, and then it will just get activated if you want to continue it. You get access to everything we're doing, including the latest edition of Mind of the Trader. And when is that, Tim?
Next Wednesday.
Next Wednesday is the Mind of the Trader, and I do believe I am the one doing the Mind of the Trader next Wednesday. And when Mark asked me to do the Mind of the Trader, my question was, do you really want everybody to get deep delve into this mind here? I don't know if that's a good thing. I got some things to say, but we are going to do a Mind of the Trader next week, and I'm specifically going to be doing it on naked puts on commodities, naked puts versus credit spreads in the futures market. That is part of the personal gold system we're working on. You also have the mastermind group today for the Tackle 25. That is later tonight for the Tackle 25. That is our covered call naked put cash flow list that we put out once a year. It's an absolutely fantastic list. We do a mastermind group for that every single, the first Wednesday of every single month. That is tonight.
Pretty incredible, all the value, honestly, that we're giving everybody. I love doing it. I'm very, very proud of it. And I'm feeling very blessed. I love what you said a minute ago, Matt. Our commute is 15 steps from our bedroom to our office, and then our kids are walking around the house and working from home. It's an amazing style of life, and I am very blessed to have it. But you got to run it day by day by day. It's a turn-based resource game. You got to wake up, you got to take your turn, you got to apply the market, you move on to the next thing, and then you're done, right? That's what trading is.
But Tim, our commute is a fantastic commute, though, and I love that. But everybody listening to this wants that commute as well. And that's what we're here to do. We're here to serve our community. We're here to serve our team and lead our team. And I just want to say thank you to all of you listeners, all of you viewers out there who are part of the greatest trading team out there, and that's Tackle Trading.
Very good. All right, guys, we're all the way done here for today. And Matt, I got to tell you, I'm the one who brought this live on Facebook. Cam normally does it. I don't know how to take it down.
It's actually very simple.
I wonder if we end the Zoom meeting.
I have no clue, but I'm fairly certain that we're going to end the Zoom meeting. And also, Tim, I'm just going to put this out there. Tomorrow's handlebar day.
I don't think you're ready, dude.
I am ready.
I don't think there's been enough back testing on this. I think I need some proof that this is going to work out. Seems like
you're trying to stall. You don't want to teach your handlebar trade.
I can teach it tomorrow. I mean, here's the thing. It's an advanced earning strategy. I have no problem going through it. If you want to do that tomorrow?
Listen, I'm not going another weekend without shaving this beard. So yes, it's happening tomorrow.
Oh no, you got to keep the handlebar as long as I'm in the handlebar trade.
That's not that was not the deal.
What do you think the deal was? That you're just going to shave it one time as a handlebar?
Halftime report with a handlebar mustache if we got 30 likes while you teach the handlebar trade.
I mean, if Tim legs out though, does he have to shave one half of the handlebar?
Tim can't grow the mustache portion of it.
I'll shave half of it. Listen, I gave Cody an assignment today, by the way, Matt. I want a meme picture. Is it a meme, Cody?
I mean,
Of Jerome Powell as one of those falconers with some falcons, some hawks on his arm. Because he's our hawk. Yeah, I don't know. You had to be there, I guess.
That probably worked out a lot better than it did. That's one of those things you practice in front of the mirror, bro.
No. Cody laughed. Maybe he was
it'll be good. It'll be good. I'll make it funny.
Cody's gonna laugh at anything you say. He's trying to impress you. He's new to the pod. He's new to the halftime report.
By the way, Cody, he was guest hosting the Coaches Lounge today. And then what we did is we went in and shared screen, and I had him going through a lot of the process. One of the best things about these actual premium pro shows, Matt, where we have our community there, is we have the chance to really work with them one-on-many, right? Mm-hmm. In these small group formats. Cody, how was that anyway?
It went well. I was on the opposite side of credit versus debit spread.
Cody, share your cam. We got to see your pretty face there. There you go. You just look better already, Cody.
Oh, I try. Can y'all see me all right? I don't see myself.
You can see yourself when you look yourself in the mirror.
I just mean like, is the lighting right? But all right, yeah, I'm here.
No, your lighting, I think I like it. It's ominous. It's dark.
Okay,
it's like a true Texan. Yeah.
I was about to move, but I'll leave it there. I could always go witness protection.
It's like you're ratting on the mafia here.
I'll go witness protection over here.
We got to get one of those voice modulators. Yeah.
No, but Cody's he's a trader up and coming, no doubt about that. One of our students. He's jumping into tackle trading now. You guys are going to get to know Cody very well over the course of the next foreseeable future, and we'll definitely bring him onto the halftime report, talk more about trading. But he's the producer of the halftime report, guys. So everybody say welcome, Cody Mackey, in the chat. Let's give him an official welcome as the producer of the halftime report. And we're looking for really big things out of Cody from a halftime report perspective. So Cody's going to come on here, produce it, help us get prepared on a daily basis so that we can bring you guys the best show out there.
Welcome, Cody Mackey. And I'm going to hold you to good trading too. I'm going to keep challenging like we did this morning, Cody, because part of the reason, Matt, why our community is what it is and why people want to become coaches and bloggers and all that, it's just that collaboration type mindset. Everybody wants to be a part of something like this and grow together. You don't go to work with Tackle Trading just to get a job, right? You do it because you have a passion for investing and trading and all that kind of stuff. We are really the kind of community and company that you got to love this. You have to love this, right?
You do it so you're in the internal conversation with a bunch of great traders every single day.
Yeah.
That's why you do it. But Tim, make me host so I can cancel out. You're struggling with technology here.
No, I can end the meeting whenever. I see the end button. I just like I like seeing you guys.
Guys, we're done with the halftime report for today. We will see you same time tomorrow. Make sure to hit the share and like button on YouTube. We'll see you next time. Tim cancels out.